Hello, Smart Money Tree Podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk, and happy Good Friday, because it's a Good Friday and life is good.
Yeah, it's good. It's a good week. Well, the markets didn't crash this week, and some people had Monday off. We had Patriots Day. The markets weren't closed on Monday; they were closed on Friday. But we did have Patriots Day in Massachusetts, and my wife walked down at I think it was like 4:30 in the morning to go get seats for for the Paul Revere's ride. I think it was that they did, and it's kind of interesting. I said she's glad she went, and probably that'll be it. And we have no interest in doing it because it's 4:30 in the morning, but that's okay.
Well, speaking of that, Kirk, so I think I told you I've got a scout trip this weekend, and we're gonna be doing trout fishing. And guess what time we're gonna be getting up in the morning to get out to the streams? So
nice.
Yes, I'll be thinking of you.
I will be dreaming of you, Doug, because I will not be awake at that hour.
Hey, by the way, it's now recorded and everybody's heard this. Kirk will be dreaming of.
I'll be dreaming about Doug.
That's a different topic for a different day.
Totally different podcast. Oh man, yeah.
It's out there now, Kirk. All right.
Yeah, well, the only way I'm going to be up at that hour, Doug, is if I'm still awake and haven't gone to bed yet, because I do not get up that early. Anyway.
Well, let me have a little fun, because that's a perfect segue. You know how much we love to talk about inflation, right?
Yep.
Well, if you're going to, whatever time you get up, whether it's 4:30 in the morning, which there's not a lot open, or maybe you decide to get up a little bit later, at some point you might want to have breakfast. And we've been talking about inflation and the impact of all of the rising prices, but there was a chart that I found that I felt was very interesting between 2020 and 2025. You might want to sleep in a little bit longer, Kirk. And here's why. Because if you sleep till noon or sleep till dinner, you would only see somewhere between a 26% to a 46% increase in prices, which is high across the board anyway. BJ's, which is a brew pub restaurant chain, get a beer, that's probably dinner, only 26% up. Buffalo Wild Wings, obviously beer goes well with that, 29% up. You get to, Hooters has got a 40% increase, which shouldn't help them because I think they just declared bankruptcy this past week. You want some lunches, you got Fridays, Applebee's, but look what you got for breakfast options there. IHOP. I don't know what's going on with pancakes, Kirk, but 82% increase in pricing when they compared the current cost of 10 menu items that are ironically equal at 16 popular casual dining chains. So I'm guessing the pancakes weren't taken into consideration because I don't think they have pancakes at Buffalo Wild Wings. But average inflation increase of restaurants was 22%. But I don't know what IHOP's doing wrong, but 82%, and I don't know what people are doing wrong to pay it. But
well, we all live in this world with higher prices, and that's just what we got to live with. And it started a while ago, and it's continue, and I don't think it's going to stop. I do want to point out a few things here today. So we're going to be talking about a lot today because there's a lot of new updates. Is earnings season right now. So for those of you who are not familiar with earnings season, every 3 months, companies come out with their earnings, and they typically congregate around the beginning of the quarter. So that would be April 1st, although I think the first earnings came out third week of April, I think it was when the first grouping came out. And then it technically will last the whole quarter. Some of them will go towards the end of the quarter, but most of them are in like the first 30 days or so. So you tend to see a lot of skews. And so what'll happen is if, let's say in Apple, I think Apple's still the biggest stock. So if Apple's the biggest stock, if they come out with earnings and it's good, the indexes will probably rise because Apple takes up a proportionally large part of the index. If Apple's stock goes down, then the index will go down. But if a stock that's worth maybe only 20 billion goes up or down, the index won't change. So with exception of like the Mag 7, which are some of the largest, you tend to get some skews. It might be a good day, and then you get some weird outlier, or a bad day, and vice versa. And so it's interesting to follow earnings season. A lot of people are coming out and saying, well, because of tariffs, yeah, we did well, but I don't know if we're going to do well in the future. So they're really kind of dampening the expectations going forward. And we'll talk about this in a minute, but it's interesting because some of the airlines have actually just said, we're not going to give guidance. They said tariffs have screwed things up so much, we're not going to give guidance at all, which is interesting. I've seen a handful of companies do this in the last 12 months, and they've just refused to give guidance. It's usually not a good sign, frankly. But I understand. I understand if they're not giving guidance. It's hard to give guidance when you have no idea what to expect. But I think what has happened, and I know Doug will talk about this. He's got an interesting story. Actually, before I go on, Doug, tell me about the story about your buddy with the shipping.
Yeah, so I have a gentleman I know that is a general manager for the North American division of a company that is actually not a U.S. based company. It's based outside the United States. They were looking actually at seeing this being potentially their best quarter. I can't remember if he said in history, but in a long time, just absolutely going to knock it out of the park. Talking to him yesterday, he said everything's frozen up. And because the reason it's frozen up is that customers are unwilling to make any decisions or any investments whatsoever right now. In his words, this is worse than COVID. So he has actually stated that going from the position of having maybe their best quarter ever to now being in a position where he may have to lay off a bunch of his North American team, if not everybody on his North American team, by the within the next couple of weeks, or the end, or at least by the end of May. That is how frozen things are. There's absolutely zero revenue. Every order has shut down.
Wow. Yeah, that's kind of interesting. So it'll be interesting to see what happens in the next 21 days, or not 21 days is probably what, 14 days. So we're looking at 10 to 14 days right around now. Yeah, so it'll be interesting to see what happens. I mean, some of these things are really intriguing, but things change so rapidly that it could be day 14 and then all of a sudden they change things around, and but it will be interesting to see how it plays out, because the supply chain, the economy, it's not just a stop and start, with the exception of COVID, where things just stopped, but they didn't really stop. Things kept kind of flowing. But yeah, worse than COVID. Yeah, it sounds like the worse than Watergate guys. Every time Trump does something, oh, it's worse than Watergate. Worse than Watergate. Oh, it's the worst thing ever. So we'll see what happens. But
in terms of their orders and everything that they're seeing, they never had the shutdown like they're seeing right now with COVID. So I think from their perspective was, I think they knew with COVID that we were facing this disease, and that it was, they at least had some direction. But where the issue is right now, there's so much back and forth and back and forth and back and forth. As we know with the markets, that freezes people up worse than almost anything. Even bad news is good news if we know what that bad news is.
Yeah, no, it makes a lot of sense. The whole supply chain thing's always been interesting to me, because there's a handful of companies that do shipping, and if you watch them, you can kind of track approximately how things are going. But if you look at things like the Baltic Dry Index, which typically marks the shipping industry, so if you want to know things are good or bad, you can look at that, and that's typically a good indicator of what's going on. But that's not showing any bad signs at the moment. So we'll see. That could change. But it's also not 100% accurate. So there are times where it was really low and things were great in the economy, and there are times where it's high and things are terrible. So, or vice versa, I mean, actually. But anyway, so there's a few things I want to touch on. One quick chart, Crime, and I'm only sharing this just out of pure humor, because if you guys don't have one of these on your phone. So this is my weather app that comes with my iPhone. And this is where my office is in Lexington. So it's 55, and this is the heart of the day. And I only pulled out like 12 to 5 because those were the highest numbers. So see at the bottom, the 10-day forecast, today's high is of 69. So Right now, it's 10:30, so it's not the peak of the day. Peak of the day is usually around 12 or 1 or 2, which is right around 60 actually later. So the high is at 69, but it never actually gets to 69. It just says here's the 69 is the high of the day, but the highest was 60. So interesting. I also want to point out one more thing, and then Doug wants to touch on something, which is the rain, which I don't have a picture of this, but I don't know if you guys know this, but if it has a picture of rain and then it has a percentage there, do you know what that means, Doug? Not sure if you do. You have
I
any idea?
do. I do know what that means.
Okay. All right. Share it.
I actually had this conversation with my son the other night and the scouts that we work with. Yep.
What's that have to do with?
It is it. I can tell you what it does not have to do with. It does not have to do with the odds of whether or not you're having a rain or
Correct.
not. I'll let you continue.
All right. So what I learned, because I always thought it was the odds. Oh, 50% chance of rain. Until somebody actually went into it and described it. It's actually the coverage ratio. So it's what percentage of the area is going to get rain. So if it's 90, for instance, tomorrow, it's 95% coverage ratio in my area, which means that it's going to rain in 95% of the area and 5% won't. Unlike last night where my app showed that it was raining currently and it wasn't. So I always love these things. If you live in Florida, it's funny because I actually keep on this weather app, I keep Miami, Florida on there just for the sake of humor. Because if I'm looking at this right now, I'm looking at today, it's 80 degrees all day and pretty much until 7 o'clock tonight. And if you look at the next 10 days, it's literally 74 to 83 every single day for 10 days. And that's not an anomaly. And there's usually about a 30% chance of rain every day. So it's the same weather every day. And it rarely rains. When it does, it downpours. But the weather never changes. So I laugh. But New England, it'll say that it's downpouring and there's no clouds in the sky. It's just we live in a weird place where the weather does not comply with the meteorologist, who I always wonder if you have to actually pass a test in college to be a meteorologist in New England, because you could flip a coin and have better odds of being right. Anyway, so moving on. I did. Go ahead, Doug.
I'm going to come back to this because since we're on chart crime, and I'll make this very fast. Pull up the restaurant one for me again.
I don't even know where it is. You'll have to point me in the direction. Doug sent me. Here it is. Chain restaurants. Here we go.
So this is the ultimate chart crime. Okay. See if you can pull this out, Kurt. When you see this, anything come to mind?
I mean, I have to read all the numbers to see, but
I'll make it real quick, real easy for those that are listening and not or watching.
Average cost.
The average cost increase of restaurants is 42%. Is the average cost increase of the cost of restaurants? What is if you look at this really closely, the highest of most of them was 46 down to 26. So really, the average is somewhere around 35. But they had to throw IHOP in at 82 to skew the entire average cost to 42%. So you made me think of that when you brought up the weather chart crime, because this is an egregious chart crime. IHOP is the outlier that shifts the entire math.
Yeah, it's very common. We talk about this in the show when people are trying to deliver a narrative, and the narrative is, oh my God, look at all this high inflation, and there's one outlier. It's this. There's like an old joke that is, you walk into a bar and the average net worth is $500,000, and then a second later, somebody walks in, the average net worth is $1 billion. It's like, well, Bill Gates walked in, right? And like that's not the average net worth of everybody, but that's why you have terms like the mean, the median, and all these things to help discern. It basically gets rid of the outliers, but that doesn't deliver the narrative. Who'd want to know about a chart where the average inflation rate is much lower? Because that doesn't help with the narrative. Mm-hmm. And it's not that this individual is a part of some big cabal trying to share narratives, which the major media is. But this is just somebody trying to prove a point. And this will bring into another point, which I think is probably important to consider, is when you're thinking about investing, you have your own narrative. You have your own theory about the way things are in the markets, right? I think the markets are going up because tariffs are going away. I think the markets are going down because Trump's a lunatic. I think the markets are going sideways because there'll be monkeys running around our street tomorrow. I mean, whatever. It doesn't matter what your narrative is. But if you have a theory, you tend to find self-supporting evidence. It's what we call an echo chamber. It's why Fox skews to the crazy right, and why MSNBC, CNN, and many other stations skew to the crazy left. Because people on the left want to hear that they're right. It's your ego. It's your ego telling you that you're smart and you're important. And the right does the same thing. We're human beings. We look for echo chambers. We're looking for self-supporting evidence that what we're thinking is correct. What you should be looking for in the markets anyway, and in life, is for evidence that contradicts your theory. Now, I don't get emotional about politics because I know I can't do anything to control it, but I try to think about it logically. And if I'm wrong, like, shoot me an argument that disproves it. I'd love to hear it. Like, I love hearing contradictory evidence because I'm trying to put together a puzzle of how the world works. And none of us have an accurate puzzle, but we try to put together the pieces best we can. And with markets, it's much the same way. I have a theory. Hey, my theory is ABC stock is going to go up and then it goes down. Okay, well, I was wrong. What am I missing? Let me go back and reassess my assumptions and figure out what's right and what's wrong, and let's move forward. But the reality is that's hard to do, right? It's hard to do for most people, and that's why you have to practice it. You have to constantly be putting yourself in uncomfortable positions because it is uncomfortable. If I believe in political argument number A, and I go into a room where people are talking about political argument B, that's going to feel really uncomfortable. Like, I don't agree with you guys. You guys are stupid. You guys are ill informed. You guys are crazy. And they're saying the same thing about the other side. It's really hard for your brain to accept stuff that it knows not to be true because your brain is trying to formulate this accurate lens on life. And if you're proven wrong, your brain rejects it. So it's hard to do, but you should try to do it, and especially investing, because you need to look at the other side of the trade and say, where am I wrong? If Warren Buffett's on the other side of the trade for me, I should be reassessing my assumptions. Say, what did I miss? Is Warren Buffett wrong or am I wrong? Well, the probability he's probably more right than me. So what am I missing? Not to say that he's always right. He's clearly made some mistakes, but you always have to be considering the other side of the trade. So I want to touch on one thing or one topic here, and then we'll switch back over to Doug, or two topics actually. So one is forecasting. So there's I saw these charts and I thought they were interesting. Which is, if you look at CEOs, they interviewed CEOs, they do surveys, and CEOs have a pretty good insight into the world. So they have their forecasts. So they look at their forecasts in January, March, and April. And the top one was, what changes do you forecast in profitability? And they expect it to be lower as it's gone forward. The CapEx forecasts. So this is how much they're spending on their company. They're investing it back into their company. Those are going to decrease over the next few months, and this starts back in January. And obviously, this is delayed, but this is when they interviewed them. And then hiring forecasts; those are also going to decline. So I think what we're seeing here are clear signs of an impending recession. Doug and I have been talking about this for the last year. It didn't happen. We also talked about how no matter who won the election, they were going to be credited with having a recession on their watch. So Trump won, so it's Trump's recession. And he'll get blamed for it, even though he had little to do, although people will claim it's him because of the tariffs. And they might be partially right. I'm not saying they're not. But we've been thinking there's a recession, and we are clearly seeing that now in the numbers. And it hasn't been noted yet as an official recession, but I think we can start seeing that. I also want to point out this before we switch over to Doug, which is the Mag 7. Mag 7, they're always right, they're always on until they're not. And we noticed this, that Mag 7, if no one has paid attention, they're down a lot. Nvidia's down 36%. This is as of a few days ago, by the way. They've come up a little bit, but this is 4 days ago. This is Monday. And then you've got Microsoft's down only 23, Apple's down 26, Google 28, and so on and so forth. You'll notice there's one missing. I guess one has been removed from the Mag 7. Tesla's apparently been removed, but Tesla's down a lot. But it's also one of the outliers. So if you look at this, you can see a clear trend here. Now, things have come back in the last few days, but you should keep note of this because for a long time, people have been Mag 7 all the time and only Mag 7. So if you've been riding the Mag 7 for the last 10 years and you lost a third of your wealth, you're still up, but it's going to hurt. And this is why diversification is important. And up until this year, not diversifying was a great idea. But if you're not diversifying now, you could put yourself into trouble. If you have a concentrated position in like Apple, Microsoft, Meta, whatever, if you have a concentrated position where most of your net worth is tied up in one of these stocks, you're putting yourself in a serious position. Because let's say Apple, for example, most of their manufacturing is coming out of China. That's our number one trade war buddy right now. The rest of the countries are a little bit better off. Not China. China has a big target on its back for Trump, and if you're doing all your manufacturing in China, you're in trouble. You know, your iPhone could go up quite a bit, and that will impact things. And so the market knows this, and that's why the market is drawing down on stock prices. And we've talked about for a while that a lot of tech companies are overpriced anyway, but this will take a little bit off the top, but it's still got a long way to go. So I just want everyone to understand that this is going on. If you haven't paid attention and your portfolio is down a lot, this is why it could be. But you could also look at some stocks that are up a lot in the last few weeks. Value stocks, particularly. You got companies like McDonald's and Coca-Cola, which haven't really budged at all, partially because they're not really affected by tariffs. But companies that are affected by tariffs are getting dinged quite a bit. So you should just be paying attention to what's in your portfolio. If you own ETFs, figure out what they own. If you own individual stocks, figure out, how they're doing in comparison. There are stocks that are doing quite well. Not many, but there are some. Many, especially some of the big mega cap stocks, are not. So just something to pay attention to. If you're not paying attention, you might want to spend a little time to start thinking about these things because they will impact your wealth. Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money. Go ahead, Doug.
Yeah. So yeah, where to unpack that? I think I think what you're referring to. I want to kind of switch a little bit here. From a diversification standpoint, I think I want to piggyback that a little bit. I agree. I think that the problem, and this is a realization of something that most people don't become aware of until it's too late. And that is that in the pursuit of the shiny gold object, although I use that.
We'll come back to that.
Yeah, we'll come back. But in the pursuit of the shiny gold object, people forget that risk is always there. Okay. And now they'll talk about risk being back in the markets, risk on, risk off. Risk on, risk off means whether or not it's time to be able to, whether it makes sense, at least by the tea leaves, to be positioned for risk, or whether it makes sense based on the tea leaves to be positioned against risk. But it's always there. And many, for the last several years, there has been incredible amount of opportunity and gain that has come from, especially from these Mag 7 type holdings. And it's driven the markets. And we've said this before, there's a whole generation that's never, that's never really experienced the opportunity to see these kind of pullbacks. And what that can invoke is a lot of poor decision making, right? Because the decision to be prepared for this risk is something that should have already been put in place. More allocations and diversification to different types of things, going back to, or at least being really keenly aware of technicals and other types of, and fundamentals and other types of variables in there. And unfortunately, what happens now is, is that when this occurs and you believe that this is going to be like the other day, okay, we just have a little dip in volatility. Well, if that doesn't occur, you start to panic, right? And you start to try to make decisions to manage that risk now when it could be too late to manage that risk. And so these are magnificent levels of change in their stock prices. And actually, we have some data that has shown that, in some ways, this pullback doesn't correlate to what's actually going on under the covers. Since 2021, you've got Google. The stock has been pretty much flat, down 1%, but revenue's up 36%. Amazon down 10%, while revenue is up 36%. Novo Nordisk, they're flat. Revenue is up 106%. So there's definitely some disconnect going on between what the revenue's been. Now, this doesn't look at profits necessarily in this, but there's definitely some disconnect between the growth of these companies and the return in the stock market that comes from outlook of where they see, the potential going. But now what you're getting is a little bit of a taste of what I believe is going to be concerns over what's going on, right? In a kind of recession, technology, especially, which Mag 7 is mostly technology. If you round out the top 10, Berkshire Hathaway continues to be in there. That has always been something that has been very, very correlated to liquidity. And if there is going to be a lack of liquidity, and we're starting to see, fortunately, M2 money supply has actually started to tick back up on the global scale. Outside the United States, there's actually been some, quantitative easing injection, which again probably correlates to why international is doing a little bit better this year than we are. But if there's going to be a tightening of cash flows, it generally is going to be a direct impact to technology of various degrees, whether it's direct spend on technology or in, company, or Amazon, which is obviously relying on where it gets its source, its products from, or the spend of companies through AWS, their web services, but also advertising. Advertising is going to dip, and you're starting to already see a pullback. For example, Kirk, Temu was a massive advertiser as they had all these cheap goods that they were trying to sell. Guess what? Now that the tariffs are in play and Temu has come out within the last week or two to say they're going to raise prices, they've shut down their advertising across the board. That will have a direct impact when that was one of the biggest revenue players in advertising in social media. So that hit Facebook, Instagram, you name it,
yeah.
Twitter.
Yeah, I mean, things are going to start to feed on themselves, and it's a healthy thing, by the way, to have a recession. We all fear recessions because they're terrible. It's really healthy to have a recession. I'm not saying they're fun, but economically we need one every once in a while. And even though under Joe Biden we had one, but he claimed we didn't, so it never was reflected, but we kind of had one. But it wasn't, but he was also right in that it was kind of like a poor version of a recession. So we really need like one that's like a quick, hard recession that we can get out of quick, kind of like every time the market crashes and bounces back. In some ways that's healthy. I did want to share this. I look at this as a chart crime. So here's a image here. Number of Europeans travel to the U.S. is created under Trump. So this is the year-over-year change in visitors to the U.S. by country of origin. Now, by this, looking at Europe, basically, you think, wow, everyone hates the U.S. It's down like 20, 30, in some cases more percent. Wow, people don't like the U.S. Maybe. Here's the thing. What else happened during that period? You want to take a guess, Doug? What else happened during that period as soon as Trump got elected? I'm going to bring up a chart here to share it with you. Off the top of your head?
From the time that he got elected, I was thinking,
it's 2025 till.
Yeah, I'll let you go ahead and talk about that.
All right. So here's what happened. Replace. I got to replace this screen sharing. Sorry. All right. So here's what happened. Here's a chart. Oh, here's a chart of the U.S. dollar. U.S. dollar was really high. Now it's really low. Okay. It was really expensive to travel to the U.S. during that time period. Now, I expect that with the dollar a lot lower and their currencies stronger, there will be more tourism coming to the U.S. Now, the tariffs might change things. I can't speak of some of these countries and how their the zeitgeist is towards the U.S. at the moment, but with the dollar cheaper, it makes it a lot more attractive for people to come to the U.S. When it was expensive, people didn't want to come here because it would just be much more expensive. I remember when I was traveling to Italy when I was in college, not only was the US dollar strong compared to, they didn't have the euro at that time, it was the lira, I think it was. And it, not only was it cheap, but everything was cheap anyway. Like it was just, there was a lot going on at the time in the late 90s, and the US was strong. There were people coming from Japan, going over to Italy and buying like, just taking like tons of Gucci bags, just stuffing them in a garbage bag and like buying them and bringing them home. Like there was a lot, it was a lot of benefit to travel. And I'm sure that will happen. I don't know if the dollar seems to be finding some strength here. I'm not sure if that will hold up, but for the moment, it certainly is. So anyway, I just wanted to share that because you see these things, you're like, wow, there must be something happening. Yeah, there's a lot happening.
Oh,
There's,
and
and
speaking of
not all international countries hate the U.S. Like they don't all hate Trump either. Go ahead, Doug.
and speaking of the shiny gold object that everybody's chasing, could that have anything to do, Kirk, with the dollar and all of us going from super expensive to super cheap?
Well, that's you hit on my next segue, Doug, because I was going to.
No, I thought I'd lead you to it.
Yes, thank you. I appreciate that.
You're welcome.
Here we go.
Oh,
So here's gold. This is as of last week. Gold's come down a little bit, but gold was above its 200-day moving average. It's 25%, which is really high. Gold's come back a little bit since. Gold has been on fire. Okay, and there's something I want you listeners to take mind of here, and it's this. There's something called the gold silver ratio. So there's two things, and I don't have this other chart. I was just thinking about it, and it'll take me a while to pull up. So there's two things you have to focus on with gold. One, and I don't have this chart, is you look at the performance of gold compared to every other currency, because every asset is a cross between your cash or the dollar. So gold is compared to the dollar. Your stocks are compared to the dollar. Bonds are compared to the dollar. So if you have dollars, you're exchanging dollars for something else. So the price that you're buying it for is priced in dollars. Now, if you're over in Europe and you're buying stocks, the euro buys a different amount of stocks than the dollar does because the euro is at a different price. So if you look at stocks, if they're going up and compared to all currencies, it's a bull market. If you own gold and gold is going up in all currencies, it's a gold bull market. If it's only going up in the dollar, could be a bull market, or it could be just the dollar's weak. I mean, there's a lot of different moving factors here, but I'm just trying to simplify the concept. So when you're looking at gold, trying to figure out if it's a bull market, figure out if it's a bull market across all currencies or most of the currencies. If it is, you're on, and you should own gold. Now, this is what we call the gold silver ratio. There is okay, thanks, Doug. I'll put that up in a second. So there are three charts here. This one is recent. Okay, this is since 2020, and we have three, so there's no chart crimes. The silver to gold ratio went as high as 115 gold to silver. This means gold was basically 115x the price of silver. Right now, it's 102, 103. It was as low as 65. This is recent. If you look more historically, if you go back another 4 years, you'd see the peak was during COVID, so that was an anomaly. The trough was right around 65. But if you go way back, if you go back like 100 years or so, you start to see things a little more clearly. So over 100 is it. I mean, not saying it's never happened. It did during COVID, but it was at like 100 way back in, I think it was the 30s, and if you look in the 70s and 80s, or I think it was 1980, right around there. That was the peak. So right now, silver is dramatically undervalued compared to gold. Now, down here in the, what I would argue is probably the late 60s, early 70s, maybe. If you go down here, you wanted to buy gold as opposed to silver, and vice versa. So what you're looking for are the extremes. So if it's on the extreme one end, this gets back to our reversion to the mean concept. If it's extreme one end, it'll tend to snap back to the mean, into the middle. It won't necessarily go all the way to the other extreme, but sometimes it can go towards the other extreme. So right now, the silver to gold ratio is it requires more ounces of silver to get gold, a lot more, and which means silver's cheap. And if you notice, gold is going through the roof. Silver's not budging, which is a really interesting oddity. And I'll see what Doug showed me. He's got a surprise chart I haven't seen yet. But okay, here we go. Thanks, Doug. So if you look here, this is the silver to gold ratio, 103. Yeah. So over 100 is just not sustainable. So the question you have to ask yourself is, is this a good idea to invest in silver versus gold? Historically, yes, right? I would say probability wise, yes. But it doesn't mean that silver is now going to rocket through the roof. Here's how this could become more sustainable ratio-wise. One is gold could go down and silver could stay the same. That's one way it could go back to normal. Another way is silver could go up, right? Silver could go up a lot. It would have to get back to a normal range, right? Or the third way, which is maybe something's broken. Maybe people don't give two craps about silver anymore, but they really care about gold. Maybe central banks around the world are buying gold because they see what's happening in the US and they want stability in their currency. Maybe there's some other scenario we don't even know about that is changing it, right? There's a lot of things that could happen. I'm not saying that's the case, but you have to be mindful of what if. Maybe central banks are buying it. That's what I think is happening. Central banks around the world are buying gold. It's driving up the price. People around the world, wealthy people, are buying gold. It's driving up the price. People don't care about silver because it's hard to buy physical silver. It's just too cheap. You'd have to have like mountains and mountains of silver to have, the same amount of gold. So it's or 100 times in this case. So I think it's just good to note that at the moment, you have this anomaly that is going to normalize itself one way or the other, right? Either gold's going to come down, silver's going to go up. One way or the other, one of these things is going to happen. So what's the way to play something like this? Let's talk about this, and I'll move it back to Doug because I want to talk about college stuff. So there's different ways to play it. One, you could bet on silver going up. Now, I know there's a lot of you gold bugs out there who just love silver and you think silver is going to go to the move. You're going to go to the moon and it's gold on steroids. Yeah. All the stuff you hear in the newsletters. I don't listen to any of it. But the reality is that it is undervalued in compared to gold. So you could do one of a few things. You could buy silver, assuming it's going to go up. And based on that assumption, you also have to assume gold's going up, because silver just has to go up a lot more. Now, mining stocks typically are the metal on steroids as well. So if you think they're all going up, then you should own mining stocks as well, because that's one of the most volatile assets on the planet. And that's like, multiples rise in the price of the metals. So you could either bet on them going up, so you bet on silver. That would be the probabilistic play. Another bet, if you thought our second scenario is gold's going down, you short gold. Well, I wouldn't do that in a bull market. I think that's really silly. I say your probabilities are against you if you're shorting gold in a gold bull market. So bad play. What's another scenario? Assuming the third one doesn't play out and the ratio is broken. If the ratio is broken, then this trade won't work. But what a lot of people do is they'll do what they call a pairs trade or a delta spread, delta trade, which is you short gold and you buy silver. Now, what that means is if both go up, you're not going to make or lose money, right? Because if they're both going up 5%, then one will lose 5, one will gain 5. So they'll even each other out. If they go down, they'll both go down the same amount. They'll even each other out. So the trade actually does not account for a general rise in the prices of all of it. What it says is that ratio is going to close from 100 to 1 down to maybe like 50 to 1 or whatever you think is going to happen. And that closing of the trade is where you make your profits. Now, if the trade widens, you're going to lose money. So the idea of the trade is you're removing market movements based on things that have nothing to do with anything other than the ratio spread. Now, people do this all the time. They might buy Microsoft and short Apple, or they might short Philip Morris and buy Altria. They would basically remove sector problems, market problems, and all they're saying is this stock is expensive and this stock is cheap, and I'm going to buy the cheap one and sell the expensive one, and I'm going to make the difference in the spread. There are a lot of traders who do that, and they can make good money if they're correct. I bring it up because it's an interesting way to play the markets that nobody talks about. You have to know what you're doing. You're not going to get burned real bad unless you make a stupid move, but generally speaking, it's a good way to reduce your risk in a way that you're normally just saying, let's just put it all on black and let's see what happens. Well, how about we put it all on black and then we short red? That'd be a better play, right? Or you go long red, but either way. So what do you think, Doug?
Well, I want to run through a couple things that are just summarize everything you talked to quickly, okay? When it comes to gold and silver, first of all, long-term historical average is around 40 to 1 to 60 to 1. So if we spike to 80 or higher, it either signals overvaluation of gold or undervaluation of silver. So we are generally a sustainable where we're at. COVID crash of March 2020, it got to 120 to 1, and the 1991 silver slump. So it may be a good time to rebalance, but here's the thing. Timing of this kind of trade is extremely difficult. Market forces, including industrial demand, which if we've got tariff wars, might actually go down, or Fed policy or inflation hedging are also going to play a major role in this. So it is possible that if you try to play the silver play, it may not go as you intend, because we may be facing something with a surge like this that's not random, right? It's could be a barometer of global fear, distrust, macro stress, like you said. Weakening U.S. dollar could be a play, monetary shift, policy shift, inflation hedging, global distrust, flight from fiat and trust decay, all could be a play here. The thing that I think that I did want to kind of address, though, you talked about, miners, versus gold. I mean, the pros of physical bullion, there's no counterparty risk. It's off-grid asset, full ownership, but there's no yield. And if you have actual holding it, it's storage, insurance, liquidity challenges. The thing about miners is, and ETFs are easy to trade. They track closely, but they're paper claims. There's no reduction rights. There's Wall Street risk. The thing about miners, you do get leveraged upside. They can pay dividends. They're undervalued relative to bullion in extreme gold to silver ratios. But you face business risk issues, management, geopolitical. They can be volatile. You can be facing poorly managed miners that underperform. So here's the thing. I would look at miners and be careful, because you can also be facing between, mine shutdowns, other types of areas. If we have a huge spike in gold, you can have energy, labor, equipment issues that go up. That could shrink margins. So there are times in which gold's going up that miners go down, and a high inflation, high rate environment can actually crush miners occasionally. And that's not even getting into nationalization risk. So look at it this way. I think there's an argument, if you're going to be going into gold this way, to definitely look at miners and gold as two different things. I would play gold as, gold or silver or the actual commodity as your insurance. And I would play the miner as your speculation, but never confuse the two. All right. Gold is not a free pass for miners to moon. Many times they struggle. So just something to be aware of.
So let's talk about college, Doug, before we wrap it up here.
Yeah. So something happened this past week or two that's really going to have a huge play. I've talked about, this is something that, a year ago we were talking about how they were going to start making people from COVID pay on student loans again and pay on housing loans. Well, they finally came out As we found, a lot of people weren't paying on their homes, right? They were still getting by, not covering those payments. The administration was forgiving or continuing to allow, or basically paying for the, on these Fannie FHA loans, paying these payments. Well, they also also did not start to enforce the payment of student loans, and that started. And the administration came out and said, not only are they going to make sure that they pay them, but they're also going to start sending them over to credit collections in the event that they that they don't start to catch up. And there is 5.3 million borrowers that are currently in default on their federal student loans. One thing I stressed a year ago that I don't think was at play enough in the market outlook is the fact that we have extremely stressed cash flows in households. For example, another chart is the median age of first-time home buyers is now 38. Back in the 90s, it was 28, so it's gone up 10 years. They're buying more expensive homes. They're paying higher interest rates. Cash flow's already been strained there, and to kick those payments back in creates challenges in cash flow that they weren't accounting for. People were not caught up. We got the same issue going on now that we add in these loan payments. It's going to cause not only a massive strain of cash flow for those that are trying to pay it, but the other thing is the double whammy. Interest rates are already high. Well, now restarting loan payments can cause credit scores to plummet. Millions of Americans may not be able to participate in the economy in a way that they were when they weren't paying on these things. And ultimately, there's 42.7 million borrowers that owe more than 1.6 trillion in student debt. More than 5 million borrowers have not made a monthly payment in over a year. They sit in default. Many are sitting in default for more than 7 years. 4 million borrowers in late stage delinquency of up to 180 days. So you're looking at almost 10 million borrowers in default in a few months. And that could be almost 25% of federal student loan portfolio going into default. Only 38% of total borrowers at all are in repayment and current on student loans. And most remain delinquent on payments, or they're in interest-free forbearance or interest-free deferment. A small percentage are in their 6-month grace period. You're looking at about 1.9 million borrowers unable to even begin repayment because of processing pause. And at the end of the day, when you start going back to, once you start having credit collections, you start to see credit decrease. Guess who's going to get hit the most? The super prime. People between 781 and 850. If you are a delinquent borrower, you are looking at almost 150-point reduction on your credit score. 80-point reduction on prime. The people that are actually already subprime are going to see the least impact. What does that mean? Now you raise interest rates on people because their credit has gone down. All of a sudden, it's a spiral, because it is going to be harder and harder to get relief, and you're looking at the next loans you take being more expensive. And I'll add one last thing on this before we close up. But this is also now what we're looking at from a standpoint of cost and home ownership. But I'm trying to find it here. Here. Mortgage refi rejections. The growing share of homeowners who can't refi amid tight credit markets. In 2025, it spiked up to roughly about 43%. Now, that's the highest since, that's actually the highest since 2013, but it's the first time we've been above, say, 2019 into 2020. What does that mean? Well, 5 ways to pay for college. I'm gonna lay this down. Number 1 is cash and assets. If you've got it, you can use them. Most people don't have enough to pay. So the second thing they're going to turn to is federal loans or private loans. Again, credit is going to come into play on both of those. High interest rates, look at the impact of people that have gone into these types of loans without a strategy. Now, the third way was to use your home. Home equity was one of the biggest ways to pay for college. Well, now, if you're seeing almost 40% of people who have applied for refinance getting rejected, got home ownership. There's a lot of people like to pay off their home, feel like they've got this debt. This is the proof right here that not only can you not refi, but many people can't tap the home equity for various reasons. The banks are only going to lend based on credit. So now all this equity you have in your home may be inaccessible. Equity can be dangerous when a liquidity shortage occurs. So I'm just going to summarize this up right now. You don't want to go into college planning with uncertainty. The only other ways to pay for it are really, from that aspect is going to be figuring out now how you're going to begin to save up for that, how you can build a strategy in which you can be your own lender, or you can deleverage yourself away from giving away your assets that you're going to need for liquidity, which could put you in a position of risk in all these other areas, or get stuck in these student loans forever, paying indefinitely, or finding that you're going to have to make really hard choices about the college that your children want to go to and the education they're going to get. We've talked about this. Things are going to break. They're starting to break. Now's the time to find out more, to have a plan. And fortunately, that's one things we specialize in. It's financial planning. It's comprehensive, but we understand this college education. Check us out, mergentcollegeadvisors.com, MERGENT, mergentcollegeadvisors.com. Get some information. Be happy to talk to you more, because this is something, it is critical that you know how this system's working.
Yeah. Well, thanks for coming on, Doug, and sharing your wisdom with us. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.